Hello and welcome to NDTV Profit. You are watching the Mutual Fund Show. I am Muralidhar Swaminathan, your host, and joining me on the show is Vishal Jain, CEO, Zerodha Fund House. Vishal, welcome to the show.
Hi Murli, good afternoon. Thanks for having me on your show.
Good afternoon, Vishal. These days we have an interesting combination of offering coming from mutual fund houses, and but you are offering the investors something very simple and easy to understand and invest in passive funds. Can you take us through why are you sticking only to passive funds?
So Murli, let me step back and explain what we are trying to achieve as an AMC. Right. Our vision is to increase penetration and participation of individual investors in the Indian capital market through the use of mutual fund products. Penetration at this point of time is still limited to about 4.5 crore investors in a population of about 140 crores, which is just about 3% of the Indian population. And to enable this vision of increasing participation, we want to equip investors with products that are easy to understand, transparent, and affordable. And passive products, index-based products exhibit these qualities in the most straightforward manner. And most of all, they're scalable, right? And therefore, our product bouquet will consist of simple exposures through index funds and ETFs. I mean, if you look at our product bouquet, we started off in November with an index fund and a passive ELSS scheme based on the Nifty Large Mid Cap 250 Index, a 50-50 exposure across large caps and mid caps. So on one side, investors got the stability of large caps, and on the other side, they got the growth kicker that comes from mid caps, right? And so those investors who are looking at investing in the India growth story could invest in this product in perpetuity without the need for any other product, and that was the objective with which we launched that product. The third product which we launched and which in fact has become a hero product for us is India's first growth liquid ETF. Again, an innovative product born from our dogged yearning and belief to make investment products easier for investors, right? This liquid ETF, liquid case, made trackability easier for investors. And one of the big things is it brought the price down from 1,000 rupees, which are the existing liquid ETFs, to 100 rupees, and therefore made it more accessible to retail investors. In a short span of time, that product has become 1,400 crores across 75,000 investors. We then went on to launch the Zerodha Gold ETF, and it's one of the cheapest gold ETFs in the market in terms of TER. Our current offering, which is the Zerodha Nifty Large Mid Cap 100 ETF and the Zerodha Nifty Mid Cap 150 ETF. Again, they're targeted equity exposures to different market segments and can be used by investors as basic building blocks for investors. With this bouquet of products, we would have offerings across equity, debt, and commodity. And therefore, for those investors who are a bit more savvy, it helps them, build individual asset allocation portfolios based on their individual needs. For others, we will look at launching a few ready-made solutions, say in the fund-of-fund format. And therefore, when an investor looks at, say, a Zerodha Fund House, he would have the ability to build his own portfolio and also be able to pick certain ready-made solutions from the products that we'll have.
Right. I will ask you a very simple basic question. It looked like an obvious one. There are so many passive funds. There are so many fund houses who offer a variety of both active and passive and ETF as well. But why should one come to Zerodha?
Again, I think it's different fund houses have different ways of selling it. I think what we are trying to do is we're trying to focus more on the retail market. We're trying to build products which are very retail centric. And it depends on each investor in that sense. If you look at, as I said, if you look at the kind of products that we're building, I gave you a simple example of a liquid case, which is a liquid ETF, again, a product which is 2 decades old. In a short span, because of the fact that we've built products which are very retail centric, we've got huge traction coming in from there. So I guess it's a fact that we're building products and the name, brings trust with it.
Right. Okay, so explain to our viewers the difference between a passive fund and an ETF, because both are very simple to use, no-brainers. There is no fund manager behind this. The market takes care of your investments. How does one differentiate between a passive and an ETF fund?
So both ETFs are passive and index funds are passive as well. It's just that they're two different structures. So if you look at the mutual fund market, or if you look at mutual funds over the last 50, 60 years, there are only three structures in the market, right? When mutual funds started off, they started off with something called as a close-ended structure, which in a sense is not very popular in today's day and age. Then you had open-ended schemes, which now are the mainstay of most mutual fund products in the market globally. The third structure which has come about is an exchange traded fund, again, a passive product, but products which you can price on a real time basis. So I would say that uh, whether it's an index fund or it's an ETF, the benefits of passive investing is what somebody should look at, which is the simplicity, the transparency, and the fact that it is very cost effective. If you have a broking and trading account, it makes sense for you to invest in ETFs which are listed on the market. If you don't have a broking and trading account, it'll be good for you to invest in passive products through the index fund route.
What is the kind of cost advantage, let's say, an ETF would have over passive funds?
If you look at the broad-based products, I don't think the difference is too much. Typically, Nifty-based, Nifty 50-based ETFs are at about 0.05% or so. Nifty 50-based index funds may be at about 0.07 or 0.08%. So I don't think the difference is too high. I think the important fact is getting exposure to a passive product, using it as a core of your portfolio to take exposure to either the India growth story or to build various kind of asset allocation models depending on your risk return profile and needs. Yeah.
Right. So, as far as passive funds are concerned, one has to go to the fund house to buy or sell. But ETF looks like they are just started picking up. There are liquidity issues as far as ETF is concerned, and there are also issues about the tracking error. How would you look at this? If would you advise an investor to go for passive fund, or would you, if it is the same basket? Let's assume that it's the same basket of stocks that are there in both. Which one would you advise an investor?
I mean, again, as I said, I don't have a preference towards an index fund or an ETF. I would say that if you are a person who has a broking account and a trading account, then buy the ETF, through the broker that you have. If you don't have a broking and trading account, buy it through the fund house directly. Today, there is a certain amount of transparency that is there in ETFs. Earlier, there was an issue in terms of people didn't know what the fair value of the ETF was. In this day and age, I mean, it's become mandatory for fund houses to disseminate the real-time NAV of the fund house of that particular ETF. So investors could go on to the specific AMC's website and look at the indicative NAV, or could also look at those NAVs on the exchange's website, and based on that, then buy or sell depending on what the NAV is.
If you could give us the example of one of your ETFs, I think you have one ETF which was launched recently. What's the kind of tracking error? What is tracking error? What is the kind of tracking error? Should investors seriously worry about it?
So tracking error is basically calculated on the end of the day NAV. And it doesn't impact you for those investors who are buying and selling the ETF on the stock market. So the tracking error is basically, in terms of the definition, is the difference between the returns of your fund versus the difference in returns of the particular index, and you take the standard deviation over a 1 year period, and that kind of becomes a tracking error of the scheme. If you look at passive products in this day and age, the tracking error of the schemes is not very high. But investors, when they're going into ETFs, they should obviously look at what the fair value of the scheme is, and based on the fair value of the scheme, buy in and around that. Now, there are pros and cons to any product, right? In the sense that ETF gives you an ability to buy and sell intraday. So let's take a simple example that the market is maybe down 1.5%, 2%, and by the end of the day goes up 1.5%, 2%. So you have the ability to enter the market at this point of time, and that's what an ETF gives you an ability to do.
Exactly. I think on the 4th of June, when the markets crashed, ETF would have given a great opportunity for investors to step in and buy instead of waiting for the day's NAV in an active fund or a passive fund for that matter. I'm sure that would have given a lot of returns.
That's right. I mean, the ability to be able to get in and get out real time is something that ETFs gives you an ability to do.
Right. What is the future of ETFs? You know, this question, the reason why I'm asking is that ETFs right now are very, very simple. They are attached to a basket of index. It could be any index for that matter. But innovative ETFs are not coming. You know, so today, for example, if there is a group whose stocks are really running, or even if it is a one stock ETF, when do we see those kind of innovative products coming into the market?
I mean, at this point of time, regulations don't permit us to have single stock ETFs. So regulations permit us to generally launch products based on a broad-based index. You can do sector indices and thematic indices and factor-based indices as well. As per the regulation states that minimum the top three securities should not be more than 65% of the index, and any individual stock should not be more than 35%. So based on those regulations, you can then do sector-based, thematic, factor-based ETFs as well. And there are quite a few which are already there in the market at this point of time for investors to choose from.
Right. Where do you see the ETF market growing? The reason why I'm focusing on ETFs is that, you know, it's cost effective, it's very simple, you can buy it anytime like any other share. Where do you see the ETF market growing from here as an industry as a whole?
I mean, the largest scheme in India today is an ETF, right? I think that itself speaks volumes about where the industry will go. I mean, look at the adoption as well. I mean, I've been in the ETF market now for about 2 decades or so, but if you look at what has happened in the last 5 years or so, there's been a 5 times increase in terms of AUM and even in terms of number of investors coming into the market. I think where ETFs help is the fact that it allows very simple exposures which are there. I think in a country like India, where there is still a large population which is still figuring out how to invest and what to do, I think passive products like ETFs and index funds will become, the first port of call for investors to kind of start their investment journeys from. And I'm quite bullish in that sense about that.
Very interesting, what to say, offering in the mutual fund industry, because the mutual fund industry is overcrowded with a large number of schemes. You know, choosing becomes very difficult, but I think that's where ETFs and passive funds come into play. It's very easy. You can simply buy ETFs or passive index funds, keep them, forget it for the next 10 years or 15 years, you will just simply grow with the market. Thanks a lot, Vishal, for joining us. That was very insightful. Thanks, viewers.
Thanks for having me. Thanks a lot.
We'll slip into a short break. On the other side, we'll be joined by Optima Money Managers founder and CEO Pankaj Matpal and take some questions from the viewers. Welcome back. You are watching the Mutual Fund Show, and I'm being joined by Pankaj Matpal, founder and CEO Optima Money Managers. Pankaj, welcome to the show. Nice to meet you and interview you after a very long time.
Thank you very much, Murli sir. It's my pleasure being on the show.
Yeah. Wonderful. So, Pankaj, we were talking about passive strategies. You know, we were looking at passive index funds and exchange-traded funds. They are gaining popularity by the day. People are realizing the value and importance of this. So, you are an expert. Tell our viewers what is the significance of investing through passive strategies or passive funds.
See, passive funds are simple to understand. That is the most important thing. For investors, there are multiple choices. They have choice to invest in broad-based index funds or broad-based ETF like large cap, mid cap, small cap, multi cap like this. or they have choice to invest in sectoral or thematic indices. At the same time, there are some factor-based investing or factor-based ETFs are available. So there are multiple choices. So investors, based on their risk appetite, their financial goals, their objective of investment, they can invest in these passive funds.
Right. So let me ask you to explain a little more about factor-based investing, because that's something new. That's a concept which is catching up. And how does it work? What kind of benefits are there? Is it something that will give you superior returns, or will it, cut down my risk?
Yes, sir. This is very important because when you invest in index funds or in passive funds, you expect the similar kind of returns what the particular index will deliver. But these factor-based investing or factor-based indices, basically these indices try or they aim to outperform the parent index. For example, if I talk about uh, Nifty Alpha Low Volatility Index, it means the stocks in the portfolio will be exactly same as in the Nifty 100 index. But because these are selected stocks out of that, so there can be a lower risk. Means the aim is to control the risk at the same time to outperform the index. So there can be selected stocks from the parent index, or there may be all the stocks from the parent index, but their weightage may differ from the parent index. For example, if we take example of Nifty 50 or Nifty 50 equal weight index fund, it means in Nifty 50 equal weight index fund, all the stocks will have the same weightage, around 2 to 3%, whereas in Nifty 50, one stock may have very high weight. At the same time, one stock may have very low weightage. So that is why, to control the risk and to outperform the parent index, this factor investing has come in means system. And there can be multiple factors like value, quality, weight, um, like this. And investors who understand the market, this can be a good choice for them.
Right, very interesting. Investors who understand the market should explore those options. But let's do one thing. Let's go across and take queries from viewers. Pankaj, as you know, a lot of viewers keep asking questions, and we have millions of viewers in the mutual fund industry. We have a query from Hemraj. He wants to know, I want to invest 3 to 4 lakhs in mutual funds for 8 to 10 years. What funds would you recommend to me?
See, for the investment horizon of 8 to 10 years, I'll say that Himraj can choose to invest in multi-cap fund as well as, diversified funds like multi-cap, large and mid-cap, and flexi-cap. So, Kotak multi-cap fund can be a good choice. At the same time, ICICI Prudential large and mid-cap fund and Motilal Oswal large and mid-cap fund. And in flexi-cap category, Nippon India flexi-cap fund can be a good choice.
Right. So that was a very simple and straight question, but the next one is very, very interesting. The next investor's name is Mohit. He is 25 years and his goal is retirement. That's okay, that's very normal. But the interesting point is he wants to retire at the age of 35. Make a note, he wants to retire at 35. He wants to invest 5 lakhs in mutual funds, and he has also invested some 30 lakhs in equity, direct equity. He is asking for recommendation. Remember, he wants to retire at 35.
Sir, he wants to retire 35, but what is his age now? That is also important to know. And I don't know, whether it's really correct to decide to retire 35, or I'll say one should retire when you have sufficient money. Or maybe that he wants to say that he wants to retire from the active job and at the same time he will do something on his own. But whatever it is, the most important thing is that 30 lakh rupees what he has now in the direct equity. See, if you can outperform the mutual funds, then you can invest in direct equity. But most of time, I have seen that investors have a basket of 40, 50 stocks in the portfolio, and the overall returns are not even matching the returns of diversified mutual funds. So only investors who have ability to outperform the mutual funds, they can invest in direct stocks, and then there should be selected stocks in the portfolio. Then only you can outperform the index. But otherwise, for most of retail investors, it is better to invest in mutual funds. And also for like 5 years investment horizon, at this point of time when we know the market, means there has been a good rally in the market, and values are little expensive for most of the stocks, my suggestion will be that one should go for large cap mutual funds, or hybrid funds like dynamic asset allocation or multi asset allocation funds.
Right. You know, that's a very, again, what to say, plan that most people would have, that I will make an X amount of money and I will retire at 35, 40 or 45. But then viewers and investors should remember that you cannot retire from investing. You will continue to invest. Only if you continue to invest, you will continue to build wealth. The other important point, Pankaj, before I take the next question is, see, in the current market scenario, let me view myself as an investor who is coming in today, and I have not invested in mutual funds at all, you know, in the past. So I get attracted to the market. I'm looking at all the indices. They are all, every day they cross new highs, you know, whether it is Nifty or mid cap or small cap. Now, what should be the strategy, you know, for two sets of people? One is somebody who is investing lump sum, the other who wants to invest month after month. What should be the strategy from here to ensure that you don't keep buying at a higher average? Because then what happens if I'm buying at with the Nifty index at ranging between 23 to 23,500, I end up buying at a higher price and my average goes up. What would be your advice? Wait for some time and then start, or simply keep start your SIP?
Sir, because we all know that it's difficult to time the market, so it will not help waiting. But yes, one can invest in staggered manner. One option is SIP, as you mentioned. So if somebody wants to manage the cash flow, means every month you are getting some income and then you want to invest out of that, SIP will be helpful. But if you have already money available with you, in that case, there are two things. One, you can opt the STP, systematic transfer plan, where you invest the lump sum amount in a low risk mutual fund scheme, and generally a liquid fund or short duration fund. And from there, you transfer it systematically to the equity fund. So STP can be helpful when you have the money available with you in lump sum. Second thing, you can choose to invest in funds like multi-asset allocation or dynamic asset allocation funds. Like in dynamic asset allocation fund, if you invest your money, fund managers, they decide that how much should be in equity, how much should be in debt, and from time to time, rebalancing keep happening. So at this moment, when you feel that markets are almost at peak and you want to invest in lump sum, you can invest in such funds where the asset allocation is managed by the fund manager. So that can also be a good choice if you are a long-term investor. So SIPs, STP, and also investing in dynamic asset allocation and multi-asset allocation funds, it can be helpful.
You know, just to add to the point which Pankaj was making, 2 points here. If you have lump sum, STP, that is systematic transfer plan, is going to be very helpful, because if you're busy or doing other things, you may forget to allocate every month. So it's better to go for a 6-month STP where your funds get transferred. That's one option. Or simply, if you have the ability and you have surplus, when markets crash, just go out and buy the best mutual funds you like. That's the best option to do, and keep accumulating and averaging. The next question, Pankaj, is from this is very important and interesting. I think this is something millions of investors want to know in this country, how to build reserve for children's education. So Mahendra, who's 44 years, wants to know, my kids' education, I want to invest 50,000 monthly in mutual funds, but he is expecting 15 to 24% return. As an aggressive investor, what funds can you recommend? I also have approximately 25 lakhs in an equity portfolio. So I think he knows the market, he wants to take risk.
Let's see, when investor asks this kind of question, the simple answer can be that you invest in thematic funds, in the themes which may outperform the broader market. For example, if we say PSU theme or manufacturing theme or infra theme, because if we expect that these themes will do better than the broader markets, can be a choice. Second thing, in long term, we also know that small cap has ability to outperform the large cap funds. But still, I will say that one should have a diversified portfolio. See, simply one can say that he's an aggressive investor, but I have my experience, whenever there is a correction in the market, most of investors, then they feel pain of that. So my advice to Mahindra that you should maintain a diversified portfolio, and your returns, 15% expectation long term may be a fair expectation from mutual funds if you have an investment horizon of say 12, 15 years, 20 years. So here again, I'll say that diversified funds should be a portfolio, multi-cap funds, large and mid-cap funds, or pure mid-cap fund can also be added to your portfolio. So in systematically, you invest in these funds. But as I mentioned about the themes, right now, like manufacturing theme is one theme, and infra or renewable energy. So some part of your portfolio, you can allocate 15 to 20% maximum in these themes for next 5 years, expecting better returns than broader market.
No, so Pankaj, there is a manufacturing, perhaps the first fund to be launched. HDFC Mutual Fund has launched a manufacturing fund, HDFC Manufacturing Fund. I guess that's the only manufacturing fund available?
No, sir. In defense, yes, HDFC is the only one who has defense fund.
Correct.
But in manufacturing, there are many funds like ICICI Prudential Manufacturing Fund. There is a Quant Manufacturing Fund. There is the Mahindra Manulife has also launched this manufacturing fund. HDFC has. So there are multiple funds in this category.
Right. There are multiple funds in the manufacturing category, and that's going to be the theme now. Go with the theme. Of course, it comes with risk, but look for diversified portfolios which can cushion your risk when the markets fall and you don't get disappointed. Stay invested, continue to invest. Not investing is a bigger risk than actually investing. Invest continuously. And Pankaj, thank you so much. Thanks, viewers, for joining us.